Welcome, everyone, to the Daniel Krug and Associates Market Update for June 2025. Today's presentation is titled Uncertainty? Certainly. My name is Rocky Istvan. I'm the Chief Compliance Officer and Associate Wealth Manager at Daniel Krug and Associates. Daniel M. Krug, CEO and Senior Wealth Manager, will be joining me for today's presentation. Before we get started, I just want to thank our portfolio research groups for their materials they provided for today's presentation, primarily City National Rockdale, where I'm going to jump into their economic indicators here. So when we look at what's going on in June, most of you are familiar with our 25 leading economic indicators and how they work. Green dials mean that that indicator is moving in a positive direction. Yellow means it's kind of neutral, and red means it's negative. So when we look at June compared to a month ago, there hasn't been a whole lot of change in our economic indicators. But what I wanted to point out is because most of you have felt, feels like a lot has been changing. Well, that's because when you go back to March, as you can see here, now on the right side, I put March in where May was. You can see a lot of the indicators that were green have moved to the left and are now in a neutral position. And that's just due to all the uncertainty that's going on. We're going to talk a little bit more about that as we move forward. But definitely things are looking like they've slowed down, and the uncertainty that's going on is bringing us in this kind of neutral wait and see position for a lot of the leading economic indicators. Next, I wanted to just give us a brief summary of the Fed meeting that took place this past week. The Fed decided to keep their interest rates unchanged, and they also expect inflation to remain elevated, with their year-end projection being around a 3% increase in inflation for the year. They did lower their growth forecast to 1.4. It was about 1.7, 1.75 before. So they're seeing slower growth. Despite the steady rate, though, they are still anticipating making 2 rate cuts by the end of this year, which is something that many expected them to do by now, but they are holding off due to the uncertainty that's going on. And the final bullet point is that they acknowledge the uncertainty is reduced. It has diminished over the last month, but it's still elevated relative to their long-term economic outlook, particularly regarding the potential of impacts of the tariffs talks that are going on. So, Dan, that's where we are going into summer.
Well, that kind of, the title that you have really kind of says it all, because there is a lot of uncertainty out there. And as you say, it is certainly uncertain. So yeah, there's a lot of things going on out there. The fact is tariffs, as the Fed said, is diminishing as far as the news. It's certainly having less impact on the stock market, but it's still out there. It's still weighing on everybody. And the fact is, until this is all resolved, there is not going to be any stability, or I guess a better statement would be, there's not going to be a clear projection on how things are going.
Yeah.
And I think when you look at the speedometers, I don't think I've ever seen it where everything's almost like dead center.
Yeah, that's just saying it's very uncertain what direction things are moving in.
Absolutely. So it's really kind of interesting. I think all in all, this will all work itself out. Always does. The U.S. is pretty resilient, and we take things in stride, and then we move forward. So let's see how this whole thing kind of plays out here moving forward.
Yeah.
So let's go on, because I think we got a lot of information here to go over. All right, so let's talk about the consumer a little bit, because the consumer, again, as you've heard us say, is driving 70% of the GDP. So why is it when we hear a lot of news out there about the turmoil that things from an economic standpoint aren't really looking that bad when we actually look at the numbers? Well, a lot of it has to do with the consumer. If you look at the charts here, we've got 4 different charts. The top left one really deals with inflation. And like Rocky said, inflation is coming down. You can see it steadily coming down. over time. So things aren't as bad as they used to be. They are getting better, but not as good as we want it to be. Now, the other side of it, so if you go to the right top, you've got the personal spending, durable goods, inflation adjusted. This is really kind of interesting because as the inflation takes effect and personal spending is adjusted, individually, everybody's family, based on what they have to purchase out there. If it was just a matter of durable goods going up, this could be a major, major problem for the economy. But the fact is the personal spending is still out there. And you might ask why? Well, it's because the wages are still high. Wages are still growing. So yes, there is inflation, but we have an economy where personal wages are going up, which allows people to spend even though the costs are higher. If you go to the lower left-hand corner, you've got inflation, income, and spending. And you can see on this chart, again, everything's kind of rising up, but the income, because it is so prevalent, because there is actual real income increasing, it is still pushing the economy forward. And then last but not least, and this is a big one, when you go to the lower right-hand corner, you've got credit card loans, delinquency rates. And as you can see on this chart, the loans and the delinquency rates are actually lower than the overall average has been over time. So there's no real pressure on people defaulting, and that usually is drawn in by the fact that the wages are very high as in comparison.
Yeah, that to me says that the consumer is in pretty good shape if they're not racking up increasing credit card debt.
Right.
So,
and that's important. So especially when you're looking at the two charts on the right, they kind of go hand in hand because of the higher wages, because people have the ability to spend, they can absorb the extra cost that inflation is kind of pushing at us right now. And the low debt is making it easier for them to do that as well. Yeah. So that's all good news right there. And that brings us now to the stock market. When you think about what's going on with the stock market, we hit a high earlier this year at 6144 on the S&P 500. And then we actually ran into what we call a healthy correction. And again, a healthy correction is where the stock market really doesn't breach 20% down in the overall market. As you can see on this, we held at about 19.1%. And after hitting it twice, we are running up again. And we're not that far off the highs when you look at where we're at right now. The stock market year to date is up about 1.5%, and we're only down 2.5% off the highs. So the reactions that the market's been having with the tariffs fueled the healthy correction. But I think we're still in a position where we're going to end up being 8 to 10% up by the end of the year. It's always good when you have corrections at the beginning of the year because you have a whole lot of time to kind of make up ground. Yeah. That's where we are with the stock market right now. And looking at getting fully invested in every position that we have moving forward. In other words, it's really going to be risk on with the portfolio to capture any kind of gains for the rest of the year. So let's go through a little bit of a recap here. The GDP estimates have been lowered primarily due to the uncertainty of the future tariff impact. Again, because we don't really know how everything's going to play out. It's very difficult to project to see how things are going to end up a year from now, 2 years from now. Inflation now at 2.4%. Again, it is coming down, but a lot of that is driven by lower gasoline prices. But if you recall, I think a couple webinars ago, we talked about the fact that the gasoline prices were going to help offset other inflationary aspects of the tariffs. And it seems to be doing that right now. Mm-hmm. Consumer spending, again, is trending higher because people have the money to spend. Wages continue to rise. Credit card debt is trending down. Very, very good thing. And the feds, again, decided to keep the federal funds rate unchanged for now. Again, they want to kind of see how the tariffs are going to play out a little bit more before they make any firm decisions. Mm-hmm. And then finally, the S&P 500 has almost recovered from the first quarter correction, but is still slightly down from the all-time highs of 61.44. That was a mouthful, wasn't it?
Yeah. It covered a lot of stuff in a short amount of time.
Yes.
Just kind of for some closing comments, the trade agreement need to be done. I mean, that's the most driving force behind the uncertainty.
Yeah, it is.
Because corporations can't plan on what their costs are going to be if they're importing, exporting, materials, goods, and services. So that's the big what if. I think the big, beautiful bill needs to be resolved by Congress. They got to decide, what the future tax picture is going to look like and all the other things in the bill. I believe both of these will get done. And I think we're going to see a really good second half of the year as these get resolved.
Yeah.
And to me, that just leaves basically, obviously, the geopolitical risk never seems to go away. And we've got the new wrinkle with Israel and Iran.
Yeah.
So we're right in the middle of that. That's bringing a lot of short-term uncertainty. But
well, it's interesting with that. You mentioned Israel and Iran, good, bad, or ugly. I think that's going to get resolved relatively quick too. So, but the question is does it escalate? And
right.
That's really what everybody would like to avoid.
Right.
But we'll see how that kind of plays out as well.
Yeah.
Some people are worried that wars are going to affect the stock market, and historically it just doesn't.
Right.
You have a momentary gyration when the news hits, but after that, the market and the economy still rolls on.
So we had a big market correction when Russia invaded Ukraine.
Yeah.
Everybody thought that's the end of the world.
Yeah.
Here we go. And 2 or 3 months later, the market started bouncing back and hasn't impacted the market since. And that's been going on for years now.
True.
So, hopefully this gets resolved with Israel and Iran, and we can kind of move forward. But again, the markets tend to shrug off a lot of this stuff after the initial shock. So,
well, and I mean, the reality is the first quarter corporate profits were really pretty good.
Yep.
And you talk about the tariffs and the fact that a lot of companies can't project out there. Every time you get another deal with another country, it solidifies the direction that people can be moving from a corporate planning standpoint.
Right.
And again, I think that's going to continue to move forward. So, and why I'm very optimistic about how the end of the year is going to turn out from a stock market standpoint.
Right.
I think we're going to be there. Could there be some more gyrations in the market? Yeah, there could. Probably will be. If we can take advantage of them from an investment standpoint, we're certainly going to do that. I'm actually pretty positive about where things are going long term here.
Cautiously positive, but things are, what we talked about structurally, things look pretty sound in the United States. It still is outpacing. We didn't talk about it, but the U.S. market is still outpacing long term the overseas market. So we're a little bit more weighted in U.S., but there is, a lot of talk that after these tariffs get settled and trade agreements put in place, you might see a little bounce back in the overseas markets in Europe and the international markets. So we might be moving in that direction down the road here.
That's a real interesting concept there. The thought you're looking at is as these trade agreements go, and you're going to have some countries that are hit harder than others, you are going to see a shift. And I would venture to say you're going to see some international go down and other parts of the international markets go up. So there is opportunity out there coming down the road, and the money managers are certainly looking at that as they're repositioning. Once they get a clear direction on the way things are going. So I think things are looking pretty good, and we're ready to go.
Yep.
Now everything's
good recap.
Everything's certain now.
Certainly.
All right. Well, let's go ahead and close this up. The reality is if you want to go to see any of the videos that we have, you can go directly to our website at mydkna.com. Click on Watch Us, DKNA YouTube, and then you will bring our site up and you can watch any one of the videos, whether it be the full length or the snackables, but there is a wealth of information there for you. And if all you want to do is kind of recap on what we talked about today, it'll still be there for you. As we always say, there's no need to worry. You take care of your family, we'll take care of you. We're ready for 2025 and beyond.
Everybody have a great day.
All right, bye-bye.